Welcome to episode 7 of Afreecanah. Afreecanah is a platform where young Africans come to share their experiences, perspectives towards leading a free life and having a free mind. So on today's episode, we're continuing from somewhere we had started off on episode 5, where we're talking about financial literacy, basically money matters, right? And we were having a conversation with Mama Bima, who I'll introduce in a minute. And our conversation was basically around the difference between savings, investments, and insurance, things young people can start with on their journey. And she had touched on budgeting, and that's where we'll pick off today. So introducing the amazing, customer-centric Mama Bima. Karibu.
Hi guys, I'm Mama Bima, a financial consultant specializing in risk mitigation, investments advisory, retirement planning, and financial wellness training. So happy to be back with you guys.
All right, yes. Thank you. So from the conversation we had last time, we had touched on budgeting, right? Mm-hmm. And you told us that the one thing young people rarely do is budget, right? And the budget is the genesis of financial literacy, financial freedom, financial health. And picking up from that, what are other things young people are missing when it comes to financial planning? What are we missing? Where are we missing the mark? You know?
If you remember, one of our very first sessions, the assignment I gave you from our first session was to sit down and do your goals.
Oh, yes.
Map out your goals, you know, from short term to medium term and long term goals. Mm-hmm. And I feel that that is one key area that people just generally miss out on, you know.
What is short? What are we talking about when we say short term? Because you see, someone's short term could be a minute, or a day, you know, or 2 weeks. What is short term? What is medium term? What is long term?
Short term, like 1 to 3 years. Mm-hmm. You know, what are those goals that you want to meet? Those financial goals that you want to meet over the next 1 to 3 years. Medium term, from anything from 3 to about 10, and then long term, now 10 maybe and plus, okay? So it's important, you know, that you actually sit down, you know, think about those goals. Maybe a short-term goal could be something like, I want to purchase a vehicle, and maybe I do not want to take a loan. I do not want to go into debt. And I keep saying this, yes, a vehicle is really important, but it's actually a bad debt. Because bad debt is where you take a loan and you purchase a depreciating asset. You know, yet you could still meet the same need by, you know, saving and actually purchasing
cash.
Yes, cash. Good debt, however, debt is good. Debt is part of life. You know, then now good debt on the other hand could be like debt that develops you. You know, debt, maybe you take a loan to start up a business. No, that's good debt. You take a loan to get back to school. You know, pay for your education, so you get a certificate or a degree, and hopefully at work, you know, you also go, you know, higher. So that could be good debt. So
what if you get debt to pay another debt? Where does that? Well, I'm representing people here. So.
Yes, it can actually be a little bit of both. So if you're taking a KCB M-Pesa loan to pay your M-Shwari, that's actually really bad debt. Okay, so you'll keep spiraling in that.
Oh, yes.
Okay. However, if you're approaching, say, a bank to take over a loan from a different bank where maybe you're really struggling and they're giving you better rates, now that is good debt.
All right.
Okay. So you can look at it that way. But generally, debt is part of life. We don't necessarily like discourage it, but as long as you have proper debt management strategies also.
All right.
Yes.
Yeah.
Yes. So, as I was saying, now for short term, for your short term goals, one of the key things that we forget to plan for is the emergency fund.
Yeah.
And we mentioned that in the previous video.
Yeah.
But young people, it's like we do not anticipate those scenarios where you could lose a job.
Yeah.
Also, if you're like self-employed, say your job could also dip.
Yeah.
For example,
There are no clients.
yes. For example, what we've seen now with COVID.
Yeah.
We've seen there are industries that have been totally flawed.
Yeah.
You can barely, even make your ends meet. The business was already set up.
Yeah.
So you actually need an emergency fund. So I would encourage everyone out there, start saving towards an emergency fund that can meet at least 6 months of your expenses. Okay? But in our kind of economy, say even after you lose a job, it may take more than 6 months maybe to bounce back, either to get another job or maybe now set up your own hustle where you can start earning an income. So if you can, push that to even 9 months. Once you're able to meet 9 months, put aside a buffer for 9 months of your expenses, then you're doing good.
Yeah.
Yes. So for short term, I would say we forget to plan for emergencies.
Yeah. Let me ask you, on that note for emergency funds,
Yes.
Let's take an example of Tony, right?
Yes.
Tony is running a business and he has personal finances and he has professional business finances.
Yes.
When we're talking about emergency funds, are we saying that Tony needs to set up an emergency fund for Tony and for Fluid Tech?
Yes.
That's what you're saying?
That's exactly what you're saying.
Okay.
And for business owners, it's very, it's good to demarcate those two.
Yeah.
Run a proper, your own proper financial plan as an individual, and also have the one for the business. So also for business, we'd expect, or we would also advise Tony to have a proper also fund, for those emergencies that they may encounter, for low seasons, so they would have a place where they'd be able to dip into and keep the business running.
Got it.
Yes.
Got it. Then we go into medium-term goals.
So now for medium-term goals, and I'll tell you, these are the most neglected.
Yeah.
We are able to see our short-term
and long-term.
And long-term. But medium-term, we really neglect them. You see, like you, Clara, at 26, in the next, say, 8 years, the next 10 years, you find that we really don't sit down and think, what will be maybe happening in my life around that time, Some of the medium-term goals we can talk about are things like maybe building a home.
Oh, yeah. Or
a home.
Yeah.
Yes, family also. By then, if you're looking to have a family, probably kids are already in the picture.
Yeah.
They're school going. So we actually forget to start saving towards that.
Okay.
And we only start like immediately now.
Yeah. Oh, and it's not the husband who's going to come and save the day?
Yes.
Okay.
I think we really need to also encourage as ladies, and I'll tell you by the way, Clara, my best clients are actually ladies.
Nice. That's encouraging.
Ladies have a savings culture. Ladies listen, they learn and commit.
Yeah.
And they give you a very easy time.
Yeah.
When you call them, they're happy, they're happy to update
Engage,
you, on progress, happy, they're happy even when you call. They never even miss your calls.
Yeah.
They're not like, Mama Bima is not calling to say I pay what, I send in my premium. So for ladies, we really need to take that power.
Yeah.
To also plan that. Fine, even as you meet your future spouse, if you don't have one yet, even as you meet them, you're also bringing something. Yes. Amen. You're also bringing something to the table.
Yeah.
And if a man also gets into your life and finds that, hey, my lady, she's well planned,
Yeah.
he'll also get his finances in order. If
good.
he hasn't.
Yeah.
Yes. So for medium-term goals, we tend to forget to plan for them. So sit down and plan out those goals.
Yeah.
Because if, say, you decide, I'm going to save up 5 million over the next 10 years, and each month, so now you work backwards, so you decide, I'm going to purchase an endowment plan, and this plan, I'll ensure that it gives me, the savings, so I'll hit my 5 million mark. At the same time, I'll have a critical illness cover. And at the same time, I will have a disability cover. Because if there's one thing that can put you down and make you stop doing what you do, Clara, it's that disability or illness at this point. So you save, but at the same time, layer up that with protection. Yes.
And let me ask you, on that note, it sounds good to the ear.
Yes.
But I wonder how a young person can read between the financial lines. In that sounds very promising. Only if I'm able to cough up that premium.
Yes.
Every, I don't know if it's monthly or annually.
Yes.
Right? So then, how then does a young person, because you see what hinders some people is, let me not talk about some people, let me talk about myself. When it comes to insurance covers, you see, I don't have the foresight of knowing whether I'll have steady income to consistently pay this every year, right? And what I sometimes think I'm committing to is that I give you my money so long as I'm able to keep giving you money. The day I stop giving you money, all of the money I've given you disappears. That's the perception I have of insurance.
Yes.
So maybe you can enlighten me and my friends or people who are like me to understand how to read between the financial lines, how to understand these things, because it sounds like everywhere we're going, on Twitter, on Facebook, someone has lost money because they lost a job. Someone has lost their life savings because they've not been able to follow up or something. So how, in line of the medium-term goals and getting the covers and getting these good instruments, how do you read between the lines?
Okay. So it's true. Insurance products, especially the life assurance ones, like the endowment plans, which are savings plans with a life cover, those require a long-term commitment from you. Okay? Now, when you get started, I think what I do as Mama Bima, I try to be very fair to my clients.
Yes.
When I come and we sit down, one, we don't go straight to the product, to the product that I want to push to you. First, I understand your money matters, like I understand your expenses, what your budget is like, how much you can afford. I would rather you start at, say, 1,500, a policy of 1,500, because that's also some providers are able to give from 1,500, others 3,000 shillings. I would rather we start at 1,500, then a year later you're like, Mama Bima, come.
I can do it.
We cannot do 5K, I would rather we start small and grow so that we give room in the event that maybe your finances take a dip, there's actually room for you maybe to recover, still be able to continue paying. However, the key thing when it comes to life insurance products, please ensure that the initial 3 years of that policy, that you're able to stay up to date with your premium payments. Now, from the 3rd year, you have what we call non-forfeiture options. Like, what are the options that are there to ensure that you do not lose that policy?
Yes.
One, you can actually do what we call paid up. you know. So if you're totally unable, say you've been doing 10,000, you've lost your job, there is no way for you to recover. You're looking ahead and you see there's nothing I can do. I can't even do the 1,500.
Yeah,
you know,
there's nothing. Yeah, I'm back home. Like,
yes.
Yeah.
So you can do what we call paid up. Let's say it was a 10-year policy. You have paid, say, for 3 years. So the premiums that you've paid for those 3 years are spread out over the period of 10 years. So the insurance company will tell you, stop paying premiums, so we'll just spread them out.
And pay you instead.
And now after 10 years, so the policy will remain in force for the next 10 years. Of course, the premium now will reduce because when they're spread out, maybe your 10K will go down to about 3,000.
Yes.
You know, it's like you are paying 3K for 10 years.
For 10 years.
Then now, upon maturity, they will actually pay you the new recalculated, sum assured, now at the new premium level. We are together. And by the premium is that monthly payment that you make. Yes.
So what you're saying is, in that 3 years, okay, person X has lost their job year 4.
Yes.
And they've gotten this pay up. That means Nduta, this is Nduta. Nduta will not get the payment in year 4.
Yes.
She'll still wait the 10-year term.
So now with paid up, let's say you are saving towards your child's education. So you've not yet met your goal. Remember, we said that when you're doing something, you have a goal in mind.
Yes.
So is it really advisable for Nduta to pull out her money or to still, you know, let the money, you know, continue growing so that she can still meet the goal? Fine. The payout eventually will be reduced because now the premium went lower, but she will be like a third way there.
Yes.
You get. So now that's paid up. But we also have other options. One, you can get your premiums back. You know, you can say, no, Mama Bima, I want the premiums.
I need it now.
Yes.
Yeah.
Don't do paid up. I just need my money back. So the insurance company is able to sit down, factoring in the 3 years that they've been managing your money, any costs, operational costs they may have incurred. Also remember, should something have happened to you during those 3 years, they would have paid you, right?
Yes.
If you had been diagnosed with a critical illness, they would have paid you. So they are able to do their math and they give you a percentage of the premiums that you've been earning, of the premiums that you've been contributing. Yes.
All right. So then let's move into the long-term goals.
Yes.
Yeah.
So now for long-term, the one thing that we forget to do is retirement planning. Okay? Yeah. And I think when we are very young, you know, you're thinking, it's so far, you know?
Yeah.
And
I'll have been a millionaire by then.
I know, like I'll be so rich. What's pension now?
Yeah.
I'll have cash money, right? Yeah. So we actually lose a lot of time, you know, anticipating, dreaming about the billions and the millions.
Yeah.
Okay? But it's important, especially for those of us who are employed. Okay? You find that for some employers, they do have occupational retirement schemes. You know, where you go, your employer has a pension scheme, but it's voluntary. You can decide to join or not.
Yes.
Okay? Please, this is free money on the table, guys.
Yeah.
Free money. Don't lose out on pension, because what happens for most employers, they tell you if you contribute 5%, we are going to match.
Yeah.
You know, or if you do 10%, we're also going to match a 10% contribution. So that is very key. If you're employed, ensure that you join the occupational retirement scheme.
Yeah.
If you're self-employed, then you actually even need to do double.
Match yourself.
Yes. Yes.
Like, okay, Clara needs a pension scheme, so save for Clara. But then when you're looking at it from Clara.inc,
yes,
like, oh, let me match what Clara did and do double. Okay.
And I keep saying, we have vehicles like an individual pension plan, and it's really affordable. It's all about commitment. we have IPPs in the market where you can start from 500 shillings per month.
What's IPP?
An individual pension plan.
Yes. Okay.
Where you can start saving from as low as 500 bob per month, but push yourself. Don't just do the bare minimum.
Yeah.
You know, also have other investments on the line towards your retirement still. Like have a brokerage account, you know. Young people need to actually invest in shares. Shares, the potential of shares making you like a really, really good return is really high, you know, and with a good advisor. We do have people who just track the shares market, like from morning till evening, from when the market opens, you know, at 9 until when it closes at 3.
Yeah.
So when you get a good agent who's able to handhold you, and you also take the power and you're involved, you know, you are able to track the performance through an online share trading platform. You know, once in a while you're also savings on the side, so that maybe when you get to 100K, you put it in, you know, you put it into the shares. And no, you don't need 100K to get started in your shares trading. I mean,
what's
even
the minimum?
The minimum to get started is 100 shares. Just 100 shares. So if you go to a counter, maybe where the share is above, with maybe 110 shillings, you're good to go, inclusive of commissions. But it's always good. If you're just a beginner, you could try and get started with about 10K, you know? Put together some 10,000 and get started. And then when you start now getting the, you know, the hang of it, now start increasing. The shares that you're buying. But go for solid counters and with a good agent, you know, someone who actually works in the stock market, because we do have independent agents, you know, who really do a good job. So with a good agent, you can actually make really good money, you know, from capital gains, from dividends, and then also now this is long-term money. This is how you create wealth. You with such investment vehicles, shares.
And you know, I understand you, because people in our generation are obsessed with generational wealth.
Yes.
Little do they or do we know that generational wealth starts now.
Yes.
Starts with what I'm doing at 26. And so that by the time I'm 56, then my daughter and my sons are reaping benefits of the things I started doing when I was at 20, you know. And, you know, God willing, if they start earning earlier, then they're able to. So the options are not buy a Ferrari or an iPhone, or it's how can I also create what mom has created for my future babe or my future kids, you know. Yeah, I understand you.
Yes, so when you're doing your retirement planning, so you've said have your pension, have a brokerage account, also do long-term, you know, long-term endowment policies, you know, that will mature like in the next 15, 20 years. Remember, this is your money. And at the point where it matures, you know, this plan will give you tax. It will be tax exempt. So you'll be enjoying tax relief. And then when the money also matures, it's tax exempt money. And at that point now, you can take that money, if it's like a 5 million that you saved or a 10M, put it into a bond, like a treasury bond. Let me tell you a story. On Thursday, I had a session with a client. She's 45 and she got laid off, you know, last year. And she has a 5 million, so she was given like a 5 million payout, you know, when she was declared redundant. And then now this money, she put it into a money market fund. So it's been earning her about 34,000 on a monthly basis. Okay, so you see it's good, eh? And so we were talking about her goals, and she told me, no, this money is actually for my, like when I get to 60 plus, I don't intend to touch it. So we started discussing different like investment vehicles, because as you know, money market is very short term. So if you're using a money market for like a 15-year goal, it's off. So I just asked her, the government just released a treasury bond, rate of return 13.44%. withholding tax at 10%. So we did the calculation. The T-bond would be giving her 52,000 on a monthly basis. Like when you now spread it, when you spread out the coupon payments, like per month, 52K. So she realized
of what she had contributed.
No, on top of, if now we were to take her 5M, put it into a treasury bond, now comparing it with what she's getting from the money market.
30 something.
Yes. So there's a difference of 18,000. And her mind was so blown. She kept saying, no, wait. So she's calculating on her end. So she's like, you say 13 point what? At how much tax? So, and it tells you, like, once you have your goals, once you understand, why am I doing this? Why am I putting this money? What is what is the goal for this money? Is it for my retirement? What is the length of time? Then, so the goals are really important, even before you do your budgeting. Even before you come up with your budget, make sure that you're able to map out your short term, your medium term, and your long term
goals.
Yes. And also for your retirement, don't just do that pension. Do the pension. Do the equities, do the endowment plan. All this money will come and converge at the point where you retire. So your pension, you'll use it to purchase an annuity, and the annuity will guarantee you a lifetime income.
All right. So the annuity.
Yes.
Explain to our audience what annuity is.
So an annuity is a life insurance product where, with your pension, let's say you retire and you have 10 million shillings. Okay? You have the option of taking 1/3 of this 10 million. And then 2/3 must. This is actually law. You cannot retire and take all of your pension and go home with it to eat. No, you're not allowed. So when you retire, you can only take 1/3 of that amount, and 2/3 you must purchase an annuity. Okay. However, and I always encourage, and this is one of the ways you find that we don't do retirement planning. It would actually be better to direct the entire amount into the annuity, because this 1/3 that you take, you're taxed up to 30%. So remember your 10M. Yes. Remember your 10M. So you've decided you're taking 1/3, so you're taking home about 3.3, right? Million.
Then 30%
and only out of your 3.3 million, only 600K out of that amount is tax exempt. The rest of the amount is taxed up to 30%. So you end up losing so much money. Yet if you were just to convert your entire pension into an annuity, there would be no tax. The only tax now comes in at the point where you're paid an income. So because now the insurance company will be paying you a monthly income. So you continue having a salary.
Like pay.
Yes, you continue having a salary. So at that point, there'll be an income tax that comes to an end when you hit 65. So at 65 in Kenya, everything now becomes tax-free for you.
My dad is living a good life.
I know, right?
Why don't you tell me these things?
So now for the annuity, so I was saying, now you see, for pension, if you had done proper retirement planning, and you had the occupational scheme that has grown you 10 million, and on the side you had investments in equities, you had investments in an endowment plan, so you have cash. You will not need to touch that 1/3. Because you already have cash. And this cash, now you can put it in your bonds, you can put it into your money market, then let the pension go into buying the annuity and no tax. Yes, and no tax penalties, if you can look at it. You can imagine being taxed up to 30%.
Even the Lord said that his people do perish because of lack of knowledge. And I think my wallet sometimes, like, since our relationship started, my wallet has been screaming, emancipation, because there's so much that we don't know. And you end up knowing too late to even plan or, to even make it work for you.
And that's usually really sad, I'll tell you. When you sit with someone who's probably 50, you know, and they're telling you, you know, maybe this is the size of my pension. How can I, you know,
do something?
Like, maybe I'm at 3 million. So over the next 10 years, how can I get maybe to 10? What do I need to be contributing, you know, on a monthly basis? And you see sort of like the lost time.
Because and this person is, if you look at the value, if they had started early, it's painful, right?
Yes.
Because this person is probably like, I don't know, a big shot lawyer or a big shot in there. And they earn really good money.
Yes, these are people, you know, they've touched really good money along the way, but they really missed on the opportunity to start early. So I always say, if you can start early, please do. There's the power of compounding interest. You know, that power of compounding interest, where for you, when you're starting at 20, like, let's say a whole life insurance cover, okay? For someone who's 25, to get a policy that will give you 10 million in the event of death, 10 million in the event of disability, 5 million in the event of critical illness, you would pay 4,900
per month.
Yeah, per month. That's your monthly contribution.
That's cheaper than the heels you buy.
Same cover for someone who's 50 years, you would pay 18,600. So, and that's the advantage you have when you're young, you know, and these things, you know, your investments, you know, your insurance, it's just, it gets way more expensive as you grow older. So the
risk is even higher at that age.
Yes, and even at 50, you'll probably approach an insurance company. They'll tell you, you know, you need to go for medical, and they'll be like, we need to load your premium, you're not in good health, you know, there's this, or they'll even reject you, you know, because of your medical condition at that time. So it's good. Start early. Yes, just start early.
All right. So the young ladies and gentlemen like me who want to start early, we're starting, Charlene, and we've learned, we've listened, and we're ready to commit. But then when I go on my socials and I talk to friends, there's a bad perception, not bad, but negative perception of financial advisors. What I see online are horror stories. What I'm hearing older people say are, don't you dare, you can do it on your own. But I can't. I don't know these things. I'm not in touch with the industry, you know, and I can only be in touch with as many industries as I can mentally. And so my question to you is, for us guys, us young people who are ready to start and commit, how do I pick out a good financial advisor? What are those things I'm looking for?
True. You know, in the past, and of course, if you go online, you'll find a lot of, you know, maybe I had an advisor who told me, you know, maybe I sent money and they disappeared, or, you know, they made me purchase a product that's not working for me.
That I even didn't need.
Yes. Especially in insurance, you know, people feel like insurance agents are just here to
milk,
you know,
milk.
and they always go maybe for the products that will give them the highest commission. But what I can say is, right now we do have agents, financial advisors who are really serious about this business, you know, and we are looking to make a change, you know, because it's not just about selling. This is a journey that I hope to walk with you in your 20s, you know, as you transition to being a family person, a business person, a business mogul, you know, into your retirement, you know. So we have really, like, even just a new thoughts in the way we do financial advisory. Probably a few years ago, You would have needed to have an insurance agent, an investments advisor, maybe a shares agent. You needed to work with very many people.
Yes.
But right now, as financial advisors, we are really investing in being all round, like a one-stop shop.
Yes.
Like if you come to Mama Bima, we'll be able to do your debt management. So that's actually coaching. We'll be able to handle your debt management. I'll guide you on how to get started with your budgeting. Then from there, and guide you on your goals, and then from there, now that's even when now we start the conversation on. So for your short term, for the emergency fund, consider the money market. And for the money market, these are the providers I would recommend. So at this point, we have financial advisors who are very, we are into this work. It's serious business. Like I left formal employment. My background was in stock brokerage, then fund management, and lastly, I had a really good role in an investment bank, but I actually saw the gap that I could fill as a one-stop shop through my agency, where you actually hold people's hand, you promote financial literacy, then you transition into that role of now being an agent or an advisor. So and one way you could start, there are very many advisors online. I always advise, please shop, come, sit with me, interview Mama Bima, like ask a question, maybe, Mama Bima, how do I get started with, money market? I'm looking to do something short term, and get to see, is this the right person? Because someone could work maybe for your mom, but then you're like, no. That's the way things are done back then, Maybe at that point, maybe they're just selling,
It's asynchronous, like it's just them speaking into this. It's not a rapport where they're trying to understand, who are you, where are you? There's sometimes where you talk with someone and you're like, this person hasn't even asked my name. So you're like, that's a red flag.
And I would also advise, go for an independent financial advisor, because now the advantage you have with such a person is they actually literally shop for you. If you're talking matters health, they'll ensure you have the best cover, but also the one that will save you, save money from your pocket. Because if I'm able to save you 20,000 in this product, then you can redirect the 20,000 into a money market fund, into a savings, or you can redirect that 20,000 into a whole life policy for the next 5 months. You have premium. So when you have an advisor who's looking to save you money, it's because they understand you all round. And a good advisor, once you build a relationship, they understand your financial needs, they will be there to, help you in that financial journey. Because there are things, your background is in tech, you're in advertising. You see, for me, I'm in investments, insurance. This is my field, and I'm good at this. So if you can have all this at no cost, guys, because
why not?
If you can have this expertise at no cost, because remember, our business is commission based.
Your network is literally your network.
So I really say that we do have good advisors, in the market, trustworthy, and people who are also out to. We get a lot of satisfaction from seeing our clients grow. From seeing a client maybe who comes to you like a month ago with so much, debt, and they've come like, Mama Bima, how can I even get started with my savings when my debt is looking like this, And, sometimes all people need is someone to talk to and help them reorganize things. So Don't be discouraged from working with an advisor. We are good at what we do. Just look for someone, shop around, get the best fit for you, and get started with your financial planning journey.
Yeah.
Yes.
Yeah. So that's really good advice. Thank
Yes.
you. And I know maybe I can speak to the young audience, or even like guys who are listening. For the things in your life, you see, in your mind, you categorize things as important, not important, and just there. You know, there's the prioritizing of things in your life. And sometimes as young people, we end up prioritizing things that have no value 5 months down the line or 5 years down the line, beyond gratification. You know, an example. You find people are willing to plan week on week on week where they'll have sherehe on Saturday and Sunday. The whole week, like Monday to Friday, it's planning. Like you have a WhatsApp group, we're planning, okay, who's driving this week, okay, who's doing that. That's planning, and that involves time, involves your effort. You're also not paying anything, it's free. Same guy, if you took that time to plan out your finances, and it's a very naked conversation you have, you're naked in front of yourself, where you can see, I spend 15,000 on Ubers, and you need to be able to see it. You know, you see that I spend, if I count all those boiled eggs I buy on the road for a week, I've spent like 3 cheese bana on eggs, you get, or on smoky pasua. And once you're able to plan with yourself, the same way you plan for your road trips, the same way you plan for your sherehe, you have the wavelength to plan for your finances. It's not Greek. It's not Greek. And all you need to do is reach out to someone who can support you. And what we did here on Afreecanah is we brought someone. So there is no excuse, guys. Like, honestly, if we meet on the streets and you're having financial issues and you've not sought out help, imagine it's not, even God is looking at you like, really? Even having the foresight of enabling your family, your dependents, you don't necessarily have to have kids. You could be taking care of your niece or your cousin, and your niece blows up. You need to be able to figure out how to advise them to move forward. So I advise you, if you don't have a financial advisor yet, please reach out to Mama Bima. I can vouch for her. I've done 2 sessions so far. We have 1 more session to do. Yes. And I'm better than I was in February 2021. We're well into the year, right? This is April. We're well into the year. So I implore you, get a financial advisor, reach out to Mama Bima, even if it's just, this is what I was thinking. I don't have money yet, but that money is going to come. You need to be ready when the money comes. So once you've reached out to her, even before you do, please subscribe. Subscribe, like, comment. It is for free. The same way the oxygen you breathe is free, even subscribing is free. Reach out to us on Afreecanah, comment on your experiences. If you know someone who would like to use this platform for their advantage and they're doing good things, reach out to me. We could plan for this. And remember to follow and like our pages. Until next time, this is Afreecanah. Thank you.